Hey, good morning. Welcome to ClearPath Retirement Radio. I am your host, Stewart Smith, and I am flying solo today, but we're going to have a good show. We're going to talk about some neat stuff today. I want to get started with what I want to talk about today, and that is what makes ClearPath different. Why did I start ClearPath? Why did I feel the need to go out and start my own retirement planning firm after spending years, almost a couple of decades working for other firms? And one of the things I realized when I was out there working for these other firms is that a lot of times what I felt like was happening was these other firms that I worked for were more focused on their bottom line and helping themselves than helping the client. And that didn't really sit right with me. And so today I'm going to talk about what led me down the path of going and starting my own firm and what makes us different and how we do things differently. What I realized is a lot of times these firms that, hold themselves out as financial advisor firms, as retirement planning firms, what they're really doing is they are trying to sell product. And we hear complaints all the time from prospects and clients that come in to meet with us. And what they feel is that they've been working with a firm that was more focused on selling a high commission product than actually doing the planning and the things that they promised to that client on the front end. So when I started ClearPath Retirement Planning, I decided we were going to be different. I decided that with our firm, planning would come first, always. Planning should always come first, and then recommending suitable products and strategies for that client that help to implement that plan and help to make that plan a reality comes second, for sure. That's what we do at ClearPath. We always sit with the client. We're going to really dig deep and understand what are your issues, what kind of retirement are you trying to live, what do your expenses look like, what are your income sources now and in the future, what kind of assets are you retiring with, and what is retirement? We paint that picture of what does retirement look like for you. And then we start to build the puzzle. And when I say that, we're building out your asset map, which is a very unique one-page at-a-glance view of all the assets and income streams that you have in your financial life. And then we start building the actual retirement income plan. And the retirement income plan is critical, okay? What that retirement income plan does is, again, we input all of your income sources, then we input your assets that you have. We assign assumed rates of return to your assets that usually are extremely conservative. And then we're going to take into account things like cost of living adjustments to your Social Security and make sure those are built in. And finally, once we have your income, your assets, and your expenses, we're going to inflate your expenses each year by roughly about 3% to keep up with inflation and make sure you don't lose purchasing power over that 20, 30 plus year retirement that you're looking at. And then once we do that, we can start to run models, right? Like we can start to run and model different scenarios for you inside that retirement income plan, and we can start to answer those critical questions that keep you up when you're laying in bed at night. Questions like, have I saved enough to live the retirement that I want to live? What is inflation going to do to my income over time in retirement? What does a major market correction look like? Can I manage through that with the assets that I've saved? And what does a really expensive healthcare event look like? Should I need skilled nursing care for an extended period of time? can I afford that? Can I afford that for myself? Can I afford that for my spouse? What if both of us need it simultaneously? And what we can do with the income plan, once we have all of the data perfect that's in there, as perfect as it's going to get, making some real basic assumptions, we can start to really model out these scenarios and say, okay, at a certain age, you're going to need, by then we're probably looking at in excess of $14,000 a month to pay for skilled nursing care. It's in that $9,000 plus a month range as we speak here in South Carolina. So, by then, with it going up over 3% a year on top of inflation, we can model that and say, okay, can we afford that? Can we afford to be in a skilled nursing facility for 4 years, which is statistically speaking the average stay for most folks who end up going that route? Can we afford that? And if we can, does it leave our spouse in a really tough spot financially? And God forbid that happens to you, and then on top of that, come to the end of your stay, now your spouse needs that kind of care and they need it for another 4 years. What does that look like? Can we manage through it? How can we address that now if we feel like that's not feasible and we can't manage through it? Are we looking at a situation where we just have to spend down our assets and qualify for Medicaid? Because a lot of people in this country are in that situation, and that's not the ideal way to address these issues. I'm sure most people don't want to be in a scenario where they have to spend down the assets they have to the point of qualifying for Medicaid and then letting Medicaid pick up the bill from there. Because if you are in a private facility that does not take Medicaid at that point, you would have to be moved to a Medicaid-approved facility, which I'm going to be honest with you guys, I've been in quite a few of them, and I wasn't really impressed. They're not the nicest facilities, so to speak. That's a reality when it comes to this type of stuff, and that's what we can help you plan for. And sometimes just really smart, really good planning can help you avoid all of these situations. That's why I started ClearPath Retirement, is because what I saw was there wasn't enough actual planning going on, and there was more just how can I position this high commission product and make a sale. And guys, I'm going to tell you, that is, that goes against every true belief that I have when it comes to helping people achieve the type of retirement that they've always dreamed about. Is not how can I position this high commission product and make a really nice commission off of this person. That should be absolutely the last thing that is on my mind. Matter of fact, I'll tell you, I don't even know. The guys in my office that work for me, they joke with me and they say, you don't even know what these products, what the commissions are that they pay. And I've made it a point over my 25-year career to not know, to not pay attention to that, because I don't want to be swayed whatsoever in my recommendations of what's right for the client because one product pays a higher commission than another. I'm always dialed in on what is the best solution for the client. And I tell you, when we really got serious about this, what we decided was we were going to change how we do things, and we were going to change how we structure things, and we were going to offer clients options. And when we're coming to the end of this first segment, but when we come back in segment 2, I'm going to kind of explain how we lay things out for clients and how we give them options to not have to try and feel the need to sell them some high commission product. It allows us to focus more just solely in on planning and looking at different strategies that are going to help that client, whether it be the tax planning that we do as far as Roth conversion strategies or tax loss harvesting and those after-tax accounts to try and keep taxes, try to control those capital gains taxes for that client. and all of the other strategies that we deploy as far as withdrawal order and what accounts do I access when. And those are the things we want to be focused on. We want to be focused on, is long-term care going to be an issue for this client? And what is the best product and the most suitable way to address that now before the client gets to a point where they can't get these products or they can't deploy certain strategies anymore because it just isn't financially logical for them to do. Like I said, we're going to dig much deeper into this. If you want to really have my team dive in and take a look for you and really have us take a look at the big picture, give you our opinion, our perspective on things coming from a true retirement planning firm, go to clearpathretirement.com, click the Get Started button today, and let's sit down and let's just have a conversation. Welcome back to ClearPath Retirement Radio. I'm your host, Stewart Smith, and today I'm talking about the issues that I saw with the retirement planning industry and the financial advisory firm industry that led me to go and start my own firm and completely change the trajectory and how I chose to do things at ClearPath. And the foundation, the basis for that was the fact that working for these other firms, I always felt pressure to maybe make recommendations to clients that weren't not because of a planning process, but because they wanted me to position a high commission product to make sure that I got a sale to that client. And I can tell you that happened time and time again. And there's a lot of local firms, retirement planning firms, that will do exactly that. What they're going to do is they're going to start with a product and position that product to see where that fits into the process to try and sell you a high commission product. And we just refuse to do that at ClearPath Retirement Planning. What we do is we start with planning first, right? We start with planning, and the planning is the most critical piece. And that means when my team dives in and we take you on as a client, we go through building a real retirement income plan for you, a plan that considers all of the aspects of your retirement, a plan that is going to deploy all kinds of strategies to try and help you minimize taxes and be as tax efficient as possible, and also help you avoid certain thresholds. The threshold to be penalized on your Medicare Part B premium, which we call IRMA, and paying a higher Part B premium because that is income based, and things like trying to keep you below the threshold of taxable income to make sure you get that extra $6,000 standard deduction that the One Big Beautiful Bill Act incorporated here recently. And a lot of times what people don't realize is when they do Roth conversions, that money is counted as income in the year that you do the conversion. So you have to be careful of certain thresholds when you do that, and making sure that when you do that you do not put yourself above these thresholds to get more of your Social Security taxed, to put yourself out of the extra $6,000 standard deduction you get through 2028 with the One Big Beautiful Bill Act, to keep you below the IRMA thresholds to where you're not paying a higher Part B premium than you have to. When it comes to retirement, there's a lot of moving parts, and especially when it comes to tax planning, and that is what my team is focused in on. That is what we really pay attention to, and that's how we're able to model through these perfect Roth conversion strategies that are optimal for the client, and is going to make sure that we're cognizant of all these moving parts and that this is the right thing. And what I noticed with these other firms is they're just not doing it. They're not doing the planning. They're shooting from the hip. And I can tell you, we don't shoot from the hip at ClearPath. What we do is we take you through a very comprehensive planning process where we're going to go through a series of meetings and make sure we've got all the right data on you, because anybody knows that in these type of situations, bad data in means bad data out. And if we don't have the right data, which we are very good at collecting and we are very experienced at making sure we have what we need from you, then we're able to put planning first, which is so important. If you've been looking for real retirement planning, come see us. Come to clearpathretirement.com. Give us a call at the office, 864-775-5033, and let us just sit down and have a conversation with you and explain where we can bring value to your retirement plan. And I think you'll really be surprised at how differently we're going to approach things than what you may have been used to in the past. So I want to go through some of the big complaints that we see when people come to us from other advisors. What we hear are things like this when we ask, and we always ask, hey, what brought you here and why are you looking for another advisor? Or what about your experience with your current advisor wasn't good and led you to look elsewhere? The number one thing we hear is they sold me a product instead of building a plan. That is the number one complaint that we hear from people coming from other advisors. They describe being recommended annuities, real estate investment trust, or REITs, or insurance products early in the relationship. And there was little discussion of tax strategy, income planning, withdrawal strategies, and they felt like maybe that advisor had a preferred product lineup where they had just some go-to products that they were going to try and line up and strategically try and sell you that product. And I can tell you that a portfolio or product recommendation is not the same thing as a retirement plan. We have people come to us all the time and they say, hey, I've got a bunch of statements in the drawer, but I really don't have a plan. I don't even know how this stuff fits together. And if that's you and you're feeling that way, you need real planning. You need a real strategic plan. You need to understand why every single thing that you own, and I'm not saying annuities are a bad thing. Annuities are just a tool in the toolbox. If a client comes to me and they're very conservative and we do a plan for them and we do a retirement income plan and we see that we really need to take a portion of what they've accumulated for retirement and fund like an indexed annuity that is going to, one, get that money out of the fee structures, because there is no fee on an indexed annuity unless you start adding riders to it. Two, allow them to get some upside of the market, participate with the upside of the market, but protect principal so they have no downside. And the money that we're going to fund that index annuity with is going to be, you're not going to need more than 10% of that a year for the next 7 to 10 years, depending on what product you use. Maybe that fits with their plan, and that could be a great bond alternative inside their plan if they don't want to be in bonds for a bond fund. Sometimes maybe that makes sense. Maybe that is using that tool correctly. But what we find is that's not how it's typically positioned. And it does cause liquidity problems if you need more than 10% of it. It can be you're tying up money for a long period of time. And some clients don't understand that when they purchase these products, and it really upsets them when they do find out, hey, I can't get to all of my money if I need to. And we've had clients that have come in absolutely livid about this. And it's just, we do a better job of understanding the client needs on the front end, understanding how they feel about liquidity and whether these things would even make sense to recommend to them. And if they say to us, no, I want my stuff liquid, I don't want to be tying money up for 10 years, then we understand that and we're going to bring a different solution to the table. Maybe we bring something like a structured note. Maybe we put them in a very conservative treasuries portfolio. There's just other ways to basically do the same thing, but not tie that money up for 10 years. And it's all about understanding your client. It's about understanding how they feel about these things, understanding their needs, and making sure that the product recommendations that you make, the tools that you bring to the table are the right tools. We hear it all the time. You can't use a hammer for everything. And that's what I feel like a lot of advisors are trying to do with these index annuities, is just force them into fitting everywhere, and they don't. If you feel like this, if you're in this situation, you're frustrated, and you just want to sit down and see, what are my options? Do I have options at this point? Because honestly, you probably do. And especially if you've owned one of these things for at least 3 or 4 years, pick up the phone, give us a call, 864-775-5033. If you're anywhere in South or North Carolina, we'd love to talk to you. We'd love to help you. We are a local upstate South Carolina firm based here in Greenville, South Carolina. We are veteran owned and operated. And we would love to talk to you. We'd love to if you don't have options, we'll tell you. We'll be honest. But if you do, we'll bring them to the table, and then you can make a good decision knowing all of your options and understanding all the details. Join us at ClearPathRetirement.com. Click that Get Started button, and let's have a conversation about it to see if we can help you. Welcome back to ClearPath Retirement Radio. I'm your host, Stewart Smith, flying solo today, and we are having an interesting discussion here about retirement planning and why I felt the need, after working for other retirement planning firms for 2 decades, to go out and start my own ClearPath Retirement Planning, and what drove that decision. And basically, as I've stated in these previous segments, I was not happy with the way that I constantly felt pressure by these other firms to sell these high commission products and not do the real planning that is necessary to really make sure people live successful retirement. After battling this for years, and going against the grain and getting a lot of pushback, because I always put planning first with my clients. And I've got clients that have been with me, met with one yesterday that's been with me for 23 years and is still as happy with me today as he ever was. And I'm proud to say that. And when I started in this business to today, for 25 years, I have always put planning first with my clients, and I have never focused on selling high commission products to my clients. I'm not going to say I've never sold annuities. Absolutely, I've sold annuities and other high commission products, but I can tell you it was always part of a plan, and it always made sense. And the client always understood exactly what they were buying and exactly what purpose it served inside of their plan. And if it was the right fit or not, if it wasn't, then it never got mentioned. I never brought it to the table. And I'm very proud to say that. And to move forward with the points that we were talking about, and the biggest complaints that we hear from people coming from other advisors to our firm, third biggest complaint, just to recap, the first biggest was they sold me a product instead of building a plan. Second one was lack of a real retirement income plan. So no clear withdrawal strategy, uncertainty about how long the money would last, no strategy for market downturns, no social security strategy. All of those things are critical when you're building out a retirement plan for someone. And the third thing is poor communication. And I'll admit, this is one of the toughest for a financial firm because everybody wants communication in different ways. Everybody has a preferred method. Everybody has a preferred amount of communication that they like. I can tell you some of my clients want to talk regularly, like every week. And then some of my clients don't want to talk to me until we get to our 6-month review, our semi-annual and annual reviews every 6 months. It's just really all across the board. So it makes it really tough for an advisor not to contact them too much or to contact them enough. And we really try to sit with our clients and understand, what are your communication needs? What are your preferred methods? How would you like me to reach out to you when the time comes? And we've gotten much, much better about that over the years with our clients. It is always a challenge, but I can tell you, you'll never hear one of my clients say, I never hear from my advisor. Or the only time they call is when they want to sell me something. That is just, we really work hard to ensure that our clients never feel that way, and that we are communicating regularly, that we are updating their plans, that life changes. Things do not stay the same. And when life changes, plans change. And when plans change, they have to be updated accordingly, and they have to be rerun, remodeled, all of those things, and we do that for our clients. So we try to take proactive communication. We definitely do periodic reviews. And I think it's the most important thing is our clients want to be communicated with when markets change, right? We've been doing a lot of phone calls with our clients here recently with all the volatility that's going on with this war in Iran and the different aspects of that. When that starts to impact markets, people want to hear from us. And so we make sure that we do that. And they're very appreciative. They want communication, okay? The fourth thing that we hear from folks is fees were not clearly explained. And usually what they're talking about here is advisory fees for managing assets. And I tell you, this is another difficult discussion because most advisors, what they'll do is they will disclose to you, if you ask them, they will disclose to you what their advisor fee is. And I think that's fair. But every advisor out there knows that's not everything. Typically, there are what we call platform fees, and that is in addition to the advisory fee to sit on whatever platform that might be, whether it be Fidelity, Schwab, any of these custodians are going to charge a platform fee, or these firms that manage the portfolios are going to charge a platform fee. And so you have to really, that has to come into effect. There's also fund fees and portfolio fees that should be mentioned. And I tell you, we try to do a much better job of making sure that people understand it's not just our advisory fee. There are some other very small fees typically that are in addition to that advisory fee. And that way the client doesn't get caught off guard and looking at the fees and wondering why it's not all adding up. Again, I think that comes down to just clear communication, being upfront with your client about everything you can disclose to that client. And many investors say they never saw a full cost breakdown. We can certainly provide you with that. And a lot of times when a client comes to us from another advisor or has a portfolio already, whether it be self-directed or at another advisory firm, we're going to actually do a comparison with that portfolio to a portfolio we would recommend. And then we're going to show you a 3, 5, maybe even a 10-year back testing track record of how our portfolio would have performed with that portfolio that you currently own. And at that same time, disclose the fees and do a fee comparison the best that we possibly can to what you have to what we would recommend. And we try to be as transparent as possible in that process and making sure that you understand all of that. Another thing that they're typically referring to when they say fees were not clearly explained, a lot of times what we find out is that is also surrender charges on annuities. Like I mentioned before, most annuities are going to allow you to access a small percentage of that annuity, whatever's funded that annuity each year, including the growth. They're going to allow you to access a small percentage of that every year. Typically after the first year, you usually can't access it at all the first year, and then starting year 2, you can start to access a small percentage of that each year without incurring any kind of penalties or surrender charges. And people, if that fits with your overall income plan, I'm never going to need more than this percentage, whether that be 7% or 10%, that should all be fully disclosed before you purchase that product. Then, that maybe that makes sense, and maybe that's a good fit for your retirement plan. But if there's a chance that you're going to need more than that, and you weren't told, that wasn't clear to you, that you couldn't access more than that without paying surrender charges on anything you accessed above that amount, then that's a problem. That should always be disclosed to you up front. You should always understand that going in, and those things should never catch you off guard. And I can tell you that a lot of people have purchased these products and they just don't understand, that is the case, and that there are liquidity problems with this product and being able to access more than whatever that set percentage is that they allow. And then if they ever get in a position where they have to access more than that and they're hit with surrender charges, that can be very upsetting. And that's when people feel deceived, and they get very upset about those things. So we make sure that all of that is talked through, disclosed, is transparent. Our clients know what they bought, how it works, what the surrender charges are, how much they can access each year. We are extremely clear on that if we recommend that type of product to a client. So if you feel like that you purchased one of these products and that you didn't really understand what was going on, you really didn't understand that there would be liquidity problems if you tried to access more than a set percentage in each year after the first year, and you really feel deceived, then give us a call, 864-775-5033. Let's have a conversation. Let's see what your options are. Let my team sit down. Let's take a look at it, and let's get our arms around it and try and see if there is a better option for you at this point to try and alleviate that problem for you. If you think that makes sense, give us a call, 864-775-5033, ClearPathRetirementPlanning.com. Hit that Get Started button today. Set up a little 15-minute phone call with me, or if you'd rather, you can set up an hour-long face-to-face appointment. We can come in, you can sit in my conference room. We've got great coffee, and we'll sit around and chat, and let's just see what makes sense and what your options are. We'd be happy to make sure you understand everything that you have. We'll be right back. Hey guys, welcome back to ClearPath Retirement Radio. I'm your host, Stewart Smith. And I am talking today about what led me to, after years, 2 decades of working for other financial planning firms and retirement planning firms, to go ahead and start ClearPath on my own, ClearPath Retirement Planning. And, what really led me to that decision was the fact that I just didn't sit right with me. The way a lot of these firms would always say the right thing. Hey, you should really do planning for your clients. But in the end, what I really felt like was happening was I was constantly being pressured to position and sell high commission products to my clients. And I never felt right about that. So I decided to go start ClearPath. And when I started ClearPath, I decided that we were going to do things differently. What I believe in is always doing the planning first. You do the planning, you discover what the needs are, and then you fill the needs with appropriate products and appropriate investments to make sure that client has the best chance possible to live the fullest, richest retirement possible. And that's what we do at ClearPath. We put planning first. And I tell you, it's been a blast. I'm sure that if I operated differently, we could generate more revenue for the firm, but that's not my concern. My concern is doing the right thing for my clients and being able to lay my head down on my pillow at night knowing that I always put that client first and I always did the planning, the real hard work to make sure that they were going to be okay. So back to the biggest complaints that we get when people come to us from other advisory firms. And just to recap, one was they sold me a product instead of building a plan. We hear that one a lot. There was a lack of real retirement income planning, meaning no clear withdrawal strategy, uncertainty about how long the money would last, no strategy for market corrections, and no Social Security strategy, no Medicare planning, no real tax planning. All of these things are just critical to, and it can't just be a few of them, it has to be all of them, working in conjunction to ensure that you're on solid ground and that you are getting the best advice possible. The next big complaint that we hear from people are, I was working with this person all through the years when I'm accumulating assets, and they always help me make money, and I feel indebted to them for that. But as I started to approach retirement, what I noticed is the advice didn't adjust. They just kept talking to me about investment advice. They just kept talking about returns, and we kept having the same conversation. And what I started to realize as I got closer to retirement was retirement's about a lot more than just investment advice. I'm starting to think about all these other things like, when's the best time to take Social Security? What Medicare plan do I pick? Am I being tax efficient now in retirement? I need tax planning. They're just talking to me about returns all the time. I need tax advice. What about estate planning? What about, do I need a trust, or is a will sufficient? I have all kinds of questions, and this person they're not helping me with any of this. They just keep talking about investments, and returns. And so what you have to understand is that's because you're working with what I would refer to in the industry as an accumulation planner, someone who's really good at investment advice and making money. But listen, returns don't take care of everything. And when you get to that next phase, when you start approaching retirement, you get within the 5 years of retirement, which is what we call the retirement red zone. You start to have questions. You start to, it's keeping you up at night. Did I save enough? Is it allocated correctly to the right investments, or am I in real danger here? Again, healthcare planning, Social Security timing, withdrawal order. What assets do I access when? What's the most efficient way to do this? And they start to realize that they need a different type of planner. They need someone who does retirement planning, who's looking at all of these things and working on all of these different things. And we do investment advice at the firm. We do investment advice. We invest money slightly different than someone younger would, because retirement investing is a very different animal in retirement. Now, we've talked about it before. We do time horizon investing, and most people retire with one portfolio and have everything like maybe 60-40, 60 equities, 40 bond type allocation. Maybe you're 50-50. But what that does is, when there's pressure on the markets and you're pulling income off of that, that portfolio to live on, and there's pressure on the markets, you start getting real nervous and you start making bad decisions out of fear. And that's what we found, is there's a different way to invest when you get to retirement. And what that typically requires, and what we deploy, is more of a 3 different portfolio approach. We're going to have one portfolio where we allocate money that is going to be your income for the first 5 years of retirement. We allocate that to one portfolio that's going to be super conservative. It's going to not fluctuate much with the markets at all. Whether that be, and we can talk all kinds of different investments that we can do that with, but we're going to pull income for the first 5 years from that bucket. And then bucket 2, that's going to be the money we're not going to touch for 5 years, and is going to get us from year 5 to year 10 on the income. That bucket is going to be more moderately allocated. It's going to take a little more risk because we're not going to need to touch it for 5 years. And then bucket 3, that is money we're not going to touch for 10 years, that bucket can be more aggressive. And by segmenting different money to allocate to different portfolios to address different time horizons, what you're doing is very dramatically increasing the chances that you're going to hit your overall assumed rate of return that you need to provide the income stream that's critical for you to live through retirement. Because what we've learned in investing, statistically speaking, if you have at least 5 years or 10 years before you're going to need that money, you can typically take more risk accordingly, because statistically speaking, higher risk assets have always performed better over longer time horizons. So it just makes sense to have things segmented and to have 3 different portfolios at least to address how you invest in retirement. Now, an accumulation planner, or someone who's working with young folks who are accumulating assets and have a very high risk tolerance and a much longer time horizon, they're looking at the world differently. They're seeing that this person can afford to take hits and recover because they've got time. And I can tell you, like in a 401k where you're making contributions and you're getting an employer match, and you're constantly seeing new money flow into that account, taking a hit in that account and recovering because you're making contributions and getting a match is much easier to stomach than when you're in retirement and now there are no more contributions, there are no more matches, there's no new funds going into that account, and you're pulling off of that account to live on and to provide you with income, and then that portfolio takes a hit. That is a much, much different feeling. And that makes you start making poor decisions out of fear. And that's what we help you avoid by having a much more strategic investment philosophy and allocation across multiple portfolios in retirement, addressing things in a much more logical way for you. If you've been working with that type of advisor and you're saying to yourself, the investment advice has been good, this person's helped me make a lot of money while I was accumulating and growing my assets, but now I'm starting to feel like this isn't maybe the right person to manage everything in retirement, and understanding that takes a much different skill set, and that retirement investing is a whole different ballgame. If you want someone who's experienced, who has been hyper-focused on retirement planning, all the moving parts that we've been talking about today, strategic tax planning with Roth conversions and all the other things that we've mentioned, if you want to see what this looks like and just how differently we would approach things for you, give us a call, 864-775-5033, or visit ClearPathRetirement.com and let us know that you want to sit down and have a conversation. Listen, a second opinion never hurts. It can never cause you harm. Just let us tell you what our take is on it. Let us help you understand what we can bring value. And we look forward to talking to you very soon.